Hello, everyone. Welcome to this week's webinar. Today, we're going to be talking about the difference between stocks and bonds and how to factor that into your overall financial plan. So, should be a shorter one today. Not a crazy concept here on the difference between stocks and bonds, but I think it pairs well with last week's webinar going over mutual funds and ETFs. This is really just breaking it down like one step further than that and getting a little bit more granular in your investments. So let's dive into today's presentation and talk about the difference between stocks and bonds. So the easiest way to think about the difference of a stock versus bond is your participation in the company that you're investing in. So both of them, you can be invested in the company, but with a stock, you actually own a piece of that company. So I like to use Apple as an example here. It's nice and easy. You buy Apple stock, you now own part of the company. And if the company does well and they sell a lot of iPhones this year, then you can benefit from owning this stock in two ways. The first would be from the price of the stock going up. Now, usually this happens because people are thinking about what means for the company, right? You sell a lot of iPhones this year, it means you're probably going to sell a lot next year, and the company's going to be successful. It's going to keep growing, and it's going to be worth 10x what it's worth right now in 10 years from now. Because you see this kind of forward looking, this is what the company is going to be worth down the road, that makes the price go up by all these people investing in them. So you're thinking future on what the company is going to be doing. Now, certain companies, not all of them, and Apple's usually not one of them, but other companies will give you profits from the success of the company because they feel like they've maxed out, they've reached their capacity, they're in a more stable situation. We call these like value stocks. So value stocks are really going to be more focused on paying dividends, which again is the profits of the company. So maybe if Apple wasn't still trying to continue to grow aggressively and put money reinvested back in their company, then what they would do is they would sell all these iPhones and then they would say, okay, every share gets $1 of the profits that we've earned this year. And so if you own 500 shares, then you get $500 for this year or this quarter. However, frequently they're paying out that dividend. So you can actually even get both from a lot of companies where you'll get the dividend payment and you'll get the growth from the price of the investment going up or down. But all of that is tied to the performance of the company. So the reverse can happen, right? The company starts doing poorly, they're not selling a lot of products this year, then you can have the price of the company's stock go down, so it's not worth as much. You could get $0 in dividend because they don't have any more profits. And so you're going to be riding that wave a lot more with that stock. Now, the opposite would be bonds, and bonds are considered safe. I like to think of these as stocks being aggressive, bonds being safe. So, where bonds fit in is you're more acting like the bank and you're lending the company money. And it could be the company, it could be the government. So, you're just lending money to people and you get to charge an interest rate and earn money off of that interest rate. So back to my example of Apple, you can lend money to Apple and then you get the interest rate, or they're promising to give you your money back plus more after a 6-month period, right? Whatever it might be, that type of structure of a loan to the company. Now, if the company does really well or really bad, you may still see a little bit of price fluctuation because in your head, you got to be thinking like, how likely are they to pay me back for this loan? So a company that does really well is going to be more likely to pay you back versus a company that's doing poorly, less likely to pay you back. So that bond's not worth as much. For someone else to go buy it off you, they may be worried that you're going to sell it to them. You get the money and they get stuck with this bond that's never going to get paid off. Now, Apple's a really strong company. You're not going to get as high of an interest rate off of that, but also it's more guaranteed that the bond's going to pay out. So it's a little bit more consistent there. Now, the government so far has never defaulted on any type of debt instrument. So that's the most guaranteed. So again, you're going to get usually the worst interest rate to lend money to the government, but they do things like having tax benefits for their bonds specifically to make up for it. So if you buy T-bills, you don't have to pay state income tax on the T-bill. You only have to pay federal income tax, so it's helping you to offset the lower interest rate that you're going to get. Where does a stock make sense? Where does it make sense to buy stocks in your portfolio? Number one, you do need a long time horizon. So I want to say the stat is that if you looked back in history at any 5-year period in the market, 72% of the time you would have a positive rate of return. If you stretch that out to 15-year timeline, there's never been a moment in history where you invested for 15 years and you had a negative rate of return. So if you think about someone who has a really long timeline that they can invest in, like for a retirement account, if they have over 15 years, we're putting a lot of their money into stocks because it's okay if the market goes down right now. We don't care. We know that it's going to be a positive rate of return in the long run. And if anything, the market going down would probably actually be a good thing for them because they can keep adding more money to this portfolio. And now they get to add it at 20 or 30% cheaper than they were adding to it previously. I would say 5-year timeline is like bare minimum where you're investing heavily in stocks. You also need to have a stomach for volatility. When I talk about this with clients, I like to mention I can think about this in the planning of if I was working with a robot that didn't have emotions, right? Here's what the book says on how I should invest for you. But then now we need to take a step back and say, okay, how are you going to be affected by this investment strategy? If you see your portfolio go down 20 or 30%, are you going to call me freaking out, wanting to sell everything and get out of the market? And I can't convince you otherwise. So that's a bad situation. Or you're not even going to probably log in and look at your account for the next 3 years because you don't really care. You're in it for the long run and you're not worried about the short term. And we can stick to whatever the book says as far as investment strategy. So we need to factor in kind of the emotional response that you're going to have to your investments paired with what the ideal investment strategy would be for someone looking just from a mathematical and financial planning perspective. Lastly, of course, growth is the goal. There's the downsides of potentially having this go down and not having money, but there's also the downside of not investing in stocks. And this is something I see with a lot of court reporters where they've put all their money into savings accounts and they don't know what to do with it. So they're just building this stockpile of money in savings. Now, hopefully they put it into a high yield savings account where you're getting at least 3-4% right now. But a lot of times they just have it in regular savings accounts that's earning 0.01%. You get pennies every month getting credited to your account. So in that scenario, you're actually losing money to inflation. Inflation is still a little over 2% right now. So you could be losing money to inflation because you're leaving it in savings and not investing it in the market. If growth is the goal and you need as much growth as possible, stocks are probably going to be a better option for you than investing heavily in bonds. So I mentioned the 15-year timeline, but just an example, a 35-year-old saving for retirement has 30 plus years until they're going to spend this money. Stocks are going to be the good fit because if we can go 15 years without a negative rate of return, think about what we can do with a 30-year timeline, right? We have plenty of time to see that upward trajectory. Now, the opposite to this, back to the bonds, is going to be a much shorter timeline. So maybe if we need the money in the next 1 to 5 years, even if you need money in 6 months, what's a hard 6 month deadline where you can lock it up for 6 months? They do make treasury bills with the government that you can buy for a 6 month period, and you can get a higher rate of return than what you would get in a high yield savings account because you're locking that money up and there's value in locking that money up. So you get a higher rate of return because of that. And you can choose, they have 3 month timelines, 6 month timelines. So those are good options, even if you have a short timeline for bonds. But most of the time we see adding bonds to a portfolio if it's under a 5-year timeline, but definitely under a 10-year timeline, we should have some bonds in the portfolio. Also, why we add bonds is not necessarily that we're going to build a portfolio for our clients that's only bonds, but we have portfolios that have stocks and bonds. And they do work inversely most of the time, where if stocks go up, bonds will go down. And if stocks go down, bonds will go up, just the way that they behave. Not to get too far into the weeds on that, but most of the time they do behave inversely. So it is reducing volatility in your portfolio by saying I'm only going to invest X percentage in stocks and the rest in bonds. So this part over here is going to be going fluctuating like crazy. This part's going to be pretty stable. So when you combine that together, you could be building a portfolio that aligns with what you're comfortable with. So you play around with that balance. Also, it's much more predictable. You're not going to see that crazy difference in the price of the bond that you buy. The main benefit is going to be the income you receive from either that interest rate, like I mentioned, or if it's one of the types of bonds like T-bills are, where you give them your money and then they give all your money back plus the interest at the end. So this is a really good option for people who are 60 plus. They want to protect their wealth. They want to have stability. They're not willing to have a portfolio go down 20 or 30% one year because they know they need to take from that account for their retirement. So we can't take from an account at 30% loss. It'll just deteriorate way too fast. So adding bonds will get some growth, but still protect their overall portfolio. So looking at the power of both, like I mentioned, is you can have a portfolio that has both stocks and bonds. And a lot of times this is what we're doing for clients is having a portfolio that does have both. The age-old standard here of a mid-range investment strategy is what we call like a 60-40 allocation, right? 60% in stocks, 40% in bonds. That's what we'd call like a balanced portfolio. So we're not too aggressive, we're not too safe. We're kind of right there in the middle. So that's really good for timelines of 3 to 5 years, maybe even 3 to 7 years, depending on your comfort with the market. And then you got to get more granular on of your 60% stocks, what ETFs are you buying to make up the 60%? How much are you weighing in US economy versus international investments, small companies, large companies, right? So there's that still a lot of strategy to figure out, but at least from a high level, how much is the more aggressive type of investment versus how much is the safer type of investment? So there used to be an age-based guideline where people would say that you should have your age in bonds in your portfolio. So for example, a 40-year-old would have 40% of their portfolio in bonds, and a 60-year-old would have 60% of their portfolio in bonds. We actually do not recommend that at all anymore because people are living so much longer. That strategy gets them safer way too soon. We need a lot of growth still. If you think about someone retiring at age 65, there's a decent probability that they could live for 30 more years. So that's 30 years of spending down money in an account. That's 30 more investment years in their portfolio. So if you back your portfolio down to only being 35% stocks and 65% bonds, that's just not enough growth to last for that timeline. Unless you way oversaved and you have $10 million in your investments, then you could probably go that route. But for most of us, you got to have a little bit more risk in that investment strategy because of that timeline that you have. One other thing that we do in our investment strategy is rebalancing. And I won't get too far into this today. We could always do like another PowerPoint or webinar on this. But what rebalancing is when you have one side of your portfolio, like your stocks doing well and your bonds doing poorly, you started at 60-40, but they're going to invest and get different rates of return. Maybe you're going to end up after 6 months, you're at 65-35 now. And then it goes 70-30, right? And it skews away from what you wanted originally because one area is inevitably going to do better than the other. So rebalancing is just pushing you back to what that original plan was, where you started at 60-40, you still want to be at 60-40, so you need to sell some and buy some to rebalance the portfolio back to that baseline that you started with. So just an example here of comparing stocks and bonds and portfolio. So if you were 100% in stocks during 2008, you would have lost 37% of your portfolio, would have been the farthest drop. If you were in a 60-40 portfolio, you only would have gone down 22%. So not only is it 15% less of a drop, but that also means less time to recover and come back up. Another thing that it means is that 40% of your portfolio did not go down at all or nearly as much because it wasn't in stocks. So if you really wanted to, you could take some of these bonds while they are still at a good rate of return and now take that money and go buy more stocks that were 37% off. So you can kind of reposition or think of your bonds as almost like an opportunity fund. If the stock market crashes, I can take my bonds and go buy more stocks while they're on sale. So just different strategies and things to think about with your investment plan. So as far as what are next steps, I think when you think about investing, you need to know your timeline. It's impossible for me to invest for someone without knowing their timeline because I don't know how much time they're going to spend the money. I don't know how much risk we can take. I said if we're investing for a robot, this is the starting investment strategy. I can't figure out what the starting investment strategy is if I don't know even a rough idea of what the timeline is, right? Is it 10 years, 20 years, 3 years, getting something to know what's the most aggressive we could go because of this timeline, then assessing that risk relative to your own comfort with the market. So are you willing to see the upswings and the downswings that this portfolio that you're thinking about has done in the past? And then get that set up. And I would say start simple, right? We don't need to go overly complex here. Just build something that you can work off of, and then you can add more complexity over time. But the biggest thing is getting started, especially like I mentioned with court reporters. I see so many with money on the sidelines that just haven't taken that leap to get investing. And that's the number one most important thing is just get started. And you can always get more creative and get more efficient, more strategic over time, but that's never going to happen if you don't take those first steps. So that's everything for today. If you want to talk about your individual situation, feel free to shoot me an email. I'm happy to do a risk assessment of your portfolio if you have one and how I think it compares to what your goals are and your timeline is, or just looking at what should be your ideal portfolio mix to give you a good idea of what that starting point would look like. So feel free to reach out and we can get that set up. Otherwise, hope you have a great rest of your week, and I'll see you all next time.